Okay, we are going to start the May Director's Cut for March production figures. I know we have some new folks on the line, so as always, please keep it on topic to that of the Director's Cut. If you have a question, please utilize it using the chat feature that we have through WebEx. I really can't stall much more for you, Ben. So,
go for it.
Okay. With that, I will turn it over to Mr. Helms.
Thank you, Allison. Thank you for everyone who logged on for our webinar and for all of you who came to the hearing room for our May oil and gas update. We're talking about March production here, so just a reminder, it's a couple of months old, but that's how long it takes to collect the data and get it filed and evaluated. So we usually start off with some numbers. We'll start with a theme for this month. You probably remember when you were in grade school playing a game called Red Light, Green Light, and that's really what's going on in the oil and gas industry these days. And so I'll try to use that theme as we walk through the report. For starters, production was down about 10,000 barrels a day, red light. Now, we had anticipated as recently as 10 days ago it was going to be much worse than that. It looked like 10 days ago we were going to drop below 1.1 million, which is a fairly significant milestone and part of what is behind the state revenue forecast, maybe the main significance about it. But we had 4 operators who came in with some amended reports and also some later reports with some significant production increases. And that pushed us back above that 1.1 million. So we were anticipating more than double that in terms of a decline, but pretty good news, really, even though a production decline, 10,000 barrels a day. Gas production up, though, green light, up over 1%. And so we continue to see the impact of drilling wells within the core area where we have a high gas-oil ratio. And even though oil production was down about 1%, gas production was up a little over 1%. On the producing well side, up very slightly, but I'm still calling it a red light. I mean, it was up 7 wells from before, and we saw a significant increase in the inactive well count, and I'll get to that in just a minute. Permitting is up a bit, green light. We went from 56 drilling permits in March to 66 in April, although that has slowed a little bit again this month, and so it's at a pace just roughly equal to what the drilling rigs can drill. They can drill 20 to 24 wells a year, which means pretty close to 2 wells a month, and with the rig count at 27, a red light down 2, that pretty much matches. So they're just permitting whatever wells that they're drilling. Oil price still below what we need in order to reactivate wells, to frack non-completed wells, to activate drilling rigs. So I'm calling that a red light as well. You can see that the statewide rig count, it's down 88% from the peak. And amazing, Williams County is down 98% from what it was at the peak. Most of Williams County is just not economic at today's oil prices. Just a small part of the southeastern corner of Williams County is economic. When we look at uncompleted wells and inactive wells, red light numbers there, uncompleted wells up 13 to 920, so it looks like companies are using that as their number one tool to manage cash flow. And then inactive well count jumped significantly, 84 from February to March, so it's up to 1,523 wells. So there's over 1,500 wells on the inactive list. Those are the wells that aren't even economic to keep producing at this oil price. And so we're not going to see workover rigs or crews activated to put those wells back on until we get a sustained 90 days above $40 WTI. That's still about 2 months away. So we've got 1 month under our belt above $40 WTI. Really a couple of months to go before the confidence is there to start mobilizing crews and putting wells back on production. Fort Berthold, on the other hand, up about 9,500 barrels a day, green light for Fort Berthold. So, I made the comment that there were 4 operators that delivered some significant production increases. 2 of those and another one partially operate, 2 of them operate exclusively on Fort Berthold, and the other one partially on Fort Berthold. So those companies really brought a bunch of wells in and increased production on Fort Berthold. On the gas side, 5-year inventory is up. Prices are very, very low. But on the flaring side, definitely a green light. For the first time since, since 2007, flaring was below 10%. We got to 9.7% of our gas flared. And we haven't been there, like I said, since December of 2007. So we're talking a little over 8 years since we've seen that number. That's some phenomenal work, and it really is something to be proud of and to be commended. I want to touch on some of the activity on the federal side. We got a red light on the BIA. There was an association that filed a motion for an injunction on that BIA right-of-way rule, and that injunction was denied. So the rule will go into effect, and meanwhile, the litigation will move forward. The situation with that rule was it was designed to streamline right-of-way approval, but it makes so many changes on the back end on the right-of-ways that everything has to be completely redesigned and rewritten. It puts so many restrictions on being able to add a pipeline to a right-of-way or transfer right-of-way rights or sell a pipeline that's in one of these right-of-ways that it makes it very, very difficult for folks. On the BLM hydraulic fracturing rule, the briefs were filed on the merits of the case. That's going forward in Wyoming District Court, federal district court in Wyoming. Briefs have not yet been filed in the appeal of the injunction. So that one, there's a lot of legal activity going on, but not much is going to happen until June, a couple of months from now. EPA has been very, very busy. I call this my blinking red light, the infamous blinking red light. Just this morning, let me back up. April 29th, the environmental groups who had filed the 60-day notice of a lawsuit concerning RCRA, Resource Conservation and Recovery Act, is what that's called, filed that lawsuit. And that lawsuit asks EPA to do a couple of things. Number one, issue more stringent regulations for the RCRA exempt things like produced water and drill cuttings, and then also to make state solid waste plan guidelines much more stringent and comprehensive. I list the place where you can go and look at the lawsuit. The state of North Dakota has determined that it should intervene in that lawsuit because there's a very high probability that a settlement could adversely impact the way we regulate that. Solid waste is regulated over the health department. Produced water injection is regulated here at Department of Mineral Resources, and both of those would be significantly impacted or could be by a settlement. So we want to make sure, number one, that North Dakota has a seat at the table if settlement negotiations go forward. We don't disagree that EPA should have and should be doing its 3-year review of RCRA standards. That should have been happening and hasn't been happening. We don't disagree with that at all, but a lawsuit is not the right way to address needed changes for the RCRA programs. And so North Dakota has determined that it should intervene. Just this morning, EPA published a couple of documents. The first one is an information request It's going to go out to some 22,000 operator facilities, asking for information, looking at methane emissions. Those are existing facilities nationwide. And that will be open for comment. So the form itself and the approach will be open for comment once it's published in the Federal Register and for 60 days after that. And so that information request isn't final yet, but just to give you an idea of the size and scope of it, they're going to have to address that information on 22,000 facilities nationwide. And then secondly, the methane reduction rules for new and modified facilities were signed. The final rule was signed by Administrator McCarthy this morning. And so that will go to the Federal Register, and it will take effect 60 days after it's published in the Federal Register. We are going to be reviewing that. We're going to have to really kick it into high gear and spend some time reviewing it. The rule is 600 pages long, and the regulatory impact analysis is another 196 pages, and we've got 60 days to figure out whether litigation is needed or whether North Dakota should do something through the judicial system with regard to that set of rules. So red light, red light, red light, a blinking red light on the EPA and the federal rules. With that, that's everything I had to talk about, and I'll take questions.
Any comments from the conference room? Okay, first question is about the EPA methane removal, that it's being described as more harsh and more costly than what was originally proposed, and it is using climate change as the justification. What are our thoughts on more harsh and costly than originally proposed, and the justification as well? So two-part question there. For the first part, we just saw the link to the rule. We haven't gone through it. We're going to be looking at it with regards to what kind of response, if any, EPA made to the North Dakota Industrial Commission's comments. So I can't really speak to that about it being more harsh than originally proposed. I don't know the answer to that. For the second part of the question, we do have significant heartburn with the fact that climate change economics or benefits are part of the cost-benefit analysis that's done on the rule. And we all know what the science shows. The science shows that about 30% of less than 0.5% of methane emissions come from the oil and gas industry. So less than 15% of total U.S. methane emissions come from the oil and gas industry. And even the most conservative climate change model shows that this rule won't move the needle on change in temperatures in terms of its impact. So we're going to be concerned if there are a lot of climate change benefits claimed in the cost-benefit analysis. But we haven't really had time to dig in and analyze it. Okay, kind of a common theme question in the last few months. Gas production is up, but oil production is down. Why is that?
And again, back to the fact that all 27 rigs are operating in the core area of the Bakken. And that area from Watford City to Killdeer to Stanley, in that triangle, has the highest gas-oil ratio. The wells are very, very productive, 3,000 barrel a day initial production rates, but the gas-oil ratios there are 2 to 4 times what they are in other areas. So gas production continues to increase. Fortunately, industry has really focused a lot of gas gathering and processing investment in that area. And so that's why you see the enormous amount of capacity at Garden Creek and Wild Basin and Johnson Corners, is that industry recognized early on there was going to be a lot of gas production in that area, I guess within the last 18 months, and focused hundreds of millions of dollars of investment there.
Great transition for the next question. How much of the flaring reduction can be attributed to production decreases, and how much attributed to better infrastructure, technologies, company initiatives?
I think you have to credit 100% of it to the latter, to improved infrastructure and technology, because gas production didn't decrease. Now, maybe a slight caveat there, and there always is one in the oil and gas industry. The concentration of activity into the core area means they can focus on a smaller footprint, a smaller area, and with the same number of pipeline crews, the same feet of pipeline going in the ground as earlier years, they're able to put all of that into a smaller area. But I think you have to credit 100% of it to investment and technology.
Since you had mentioned that the drop in oil production was not as severe as you thought it was going to be, what are you looking ahead for the next couple of months?
Well, I keep expecting the type of production declines that we saw in December and January, and perhaps this little increase that we've seen in oil prices, the most recent largely due to idling of the Canadian oil sands production, has strengthened people's resolve a little bit. But as we keep seeing higher and higher inactive well counts and increasing non-completed well counts, we really should be, I would expect, seeing those kind of 30,000, 35,000 barrel a day production declines like we saw in December and January. So I continue to wait for that shoe to drop. You can't go very many months at 27 rigs and less than 60 completions and maintain production. So I still think we very well are looking at 1 million barrels a day or slightly below by the end of the year.
Okay, any thoughts on the Canadian wildfires having an effect on North Dakota production?
Well, I don't think the wildfires have impacted our production, and certainly not, back in March production, but I'm not hearing anything about an impact on production even currently. The impact has been world oil price. It is surprisingly little impact for the fact that there's 1 million barrels a day or thereabouts off production, and so it really says something about the impact of shale oil, that we live in a world where you could take 1 million barrels of production a day off the market, and the market kind of goes, yeah. I mean, that's pretty significant when you think about it. Not very many years ago, something like that would have resulted in enormous price increases and all sorts of disruptions. But the market is just really, really solid on the supply side these days. And, North Dakota represents only about a third or less of the non-completed wells, which within a matter of weeks can be in production. So it speaks to the amount of oil that's in storage as well as the non-completed well inventory.
If you haven't muted your mic, I'm trying to go through and mute everybody. If you haven't muted your mic, please do so, because people are on the line that are being very disruptive. I apologize. I thought I had grabbed everybody, but they're coming in late, I guess. So, okay, so we have been talking about methane emissions, so I'm going to let this one pass.
I brought it up. No.
Obviously, a report came out with methane yesterday. What are your thoughts on the study showing the Bakken is responsible for a large percentage of methane emissions, U.S. methane emissions?
So all of this from the same flyover and the same time period, 2 different studies. It was University of Michigan, I think, that published a study showing Bakken responsible for a very large percentage of the world's ethane emissions. And then there were the estimates of methane emissions that were made by EPA and various groups that are responsible for doing that. And I think just yesterday, a study came out from University of Denver, or one of the Colorado schools, showing that methane emissions are actually less than what was projected. So methane a little bit less than projected, ethane higher than expected. I think the thing I want to say is this is all tracing back to 2014, like March, April, May of 2014. That's when the data was collected. And I just need to remind folks that it was December of the year before, or right around that time, that we were flaring 36% of our gas in North Dakota. And we were kind of in the middle of implementing the health department's VOC reduction program. So I personally think that current methane and ethane emissions are likely much, much lower than what they observed in the spring of 2014. One of the things that those large flares that we had, and they were very smoky flares back then, there's a lot of new technology and a big reduction in flared volumes. One of the impacts of that is going to be a lot less ethane emissions. So it's unfortunate that it's 2 years old, but I don't think it's really reflective of what's going on today. And the state has responded in those 2 years, responded with a VOC emission reduction program and responded with a gas capture program, both of which are very, very successful.
There are no more questions from the webinar.
Did you say EOC?
VOC. Yep. Volatile organic compounds. And, you know, they at the well site roughly correlate to methane emissions, but as you move the gas further and further down the collection system, those are left behind in the liquids, and the methane moves on to the plants. And so as the gas moves from the well to the gas plant to the pipeline, that ethane plus content goes down.
There is no more questions. Just one thing real briefly. I don't know if you want to run through any talking points on the break-evens. We briefly mentioned them, but we never really ran through them. So
yes,
we put out break-evens quarterly. So if you just wanted to.
I apologize. I don't think I brought that printout. Yes, let me see if I brought that printout with me.
I
Sent it to you. Yes. Okay. So break-evens, we did them just a little bit different this quarter. One of the things that we've decided to do is on prospective things like break-even prices and that, to switch to a WTI price. That's the price that y'all can look at online. That's the price that you see every day on the NYMEX. And so rather than do those in terms of a North Dakota wellhead price, we're going to continue to use that historically because we have that data going all the way back to 1954 when the Tesoro refinery. So it's great for trending and that sort of thing. But when we start talking about future activity, like break-even oil prices, we're going to switch to WTI prices. Some of the historical ones we did, if you want to just add about 15% to them, it would be roughly equal. A couple of other items there. You can see that the counties that are now economic to drill in have increased substantially. A lot of that is because well costs have dropped significantly and prices have come up. And so you can see that we now have Dunn, McKenzie, McLean, Mountrail, Stark, and Williams County all in the black in terms of future drilling. I put the counties where part of the county is economic and part of it's not in gray, and then there are some counties that obviously have a long way to go in terms of becoming economic. One of the other factors here is that with the big drop in rig count, some of the counties didn't have enough data to really do a good estimate, a new updated estimate, and so I put a star by those, and I'm using the previous quarter, and I'll continue to do that as we go forward. But I think that the overall picture that you see is that break-even oil prices are down significantly because industry has reduced drilling costs and operating costs about 65% between the two. And so the economics are more robust for North Dakota. And again, it speaks to the fact that what industry has been saying, above $60 a barrel WTI, this is the best place to spend money. And that's the key trigger.
Okay.
All right, I do have one other.
Great.
I'm just kind of curious. If prices rebound and industry is interested in, going gung-ho on fracking again, are there enough crews out there to do it right now?
Yeah, so the question was crews available for ramping up fracking if prices rebound, and you and I both agree it's not a matter of if, it's a matter of when. The longer it lasts, the more difficult that is becoming. And what I can say is that the major service companies have been trying to convert their frac crews from supercommuters to North Dakota residents. That's for the existing 5 or 6 frac crews in the state. I think it's going to be a big challenge. I think that it will be hard to hire them, and it will be hard to get them trained. One great piece of news is we have the new Train ND facility in Williston, and they can, in a matter of about 10 days, train somebody to be ready to go on a frac crew. But it's going to be very hard to entice them back and to hire them back. In fact, at the grocery store last night, I was talking to the father of an individual who graduated high school with my son and was working on a frac crew. And he's looking at work in his home state and trying not to come back. He's been offered the opportunity to come back to North Dakota, and he's trying to find a job at home instead of super commuting again. So it's going to create a lag in activity.
Okay.
Thank you.
Did you need that?
I just turned it on.
Okay, perfect. Good, Ken.
You are good, sir.
Okay, well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I will get right in with a couple of quick production updates from neighboring states. And so continuing to see sliding production in eastern Montana as well as South Dakota. And again, why I keep track of this, we share the same transportation network with the neighboring states on the U.S. side of the border. And so for crude oil movement out of the region, it's important to understand what's happening in these other plays as well. And so, but with sliding production in all 3 areas, again, less production than having to be moved out of the region either by pipeline or rail. In March, the estimated breakdown, you can see again a pretty significant shift towards pipeline transportation versus rail transportation. And so now only 35% of the oil estimated to be moving out by rail car, the remainder either being refined in the state in Mandan or in Dickinson, or being moved out by pipeline to refineries around the U.S. You can see the historic trend, again, pipeline market share shown in the blue line and rail market trend shown in purple. And so again, continued uptick in utilization and market share on the pipeline side and continued decreasing on the rail side. Again, primarily market driven. That's one of the key drivers in that the economics just are not there right now for folks shipping on those systems to want to utilize rail. The economics favor pipelines at the moment. On just a pure volume basis on slide 6, taking a look now, we're down somewhere just above 400,000 barrels of oil per day estimated to be moving out on rail cars. So we're back to the 2012 type volumes that we were seeing. And so definitely down from the peak of over 800,000 barrels of oil per day moving out by rail. Where those barrels are heading, again, the East Coast continues to dominate where those trains are headed. It's actually picked up a little bit of market share over the West Coast. Again, I expect these trends to continue. I don't see anything shifting these, at least in the near term. And so those barrels that are leaving North Dakota, again, either headed primarily to the East Coast and some headed towards the West Coast as well. Pricing information from February, that's the most recent available. Again, just showing what refineries in the different districts of the U.S. were paying for their crude oil. The East Coast had the highest, followed by the West, and then the Gulf Coast. But again, in order to get to the East Coast or the West Coast, the only option is by rail. And so you'd have to look at the economics, and again, they just weren't there for that added transportation cost to reach those higher price markets. And where we sit today, just over $1 spread between Brent and WTI pricing. So again, in the near term, I don't expect any big shifts. I expect to continue to see pipelines pick up market share and be the preferable option for barrels leaving the region. Another big driver in the decrease in volume leaving North Dakota, again, either by pipe or by rail, is we saw a significant decrease in the last couple months on crude oil coming across the border from Canada. And so that's about a 40,000 barrel a day swing, and so it's not insubstantial or unsubstantial. Those are barrels that are not coming into North Dakota and that do not have to leave North Dakota by one of our transportation methods. On the flaring side, again, there were some questions and discussions earlier with Lynn. We continue to see majority of the gas being flared is coming from wells that are connected to pipeline systems, but that has been shrinking. The blue portion of this puzzle has continued to stay pretty steady at about 3%, but we've continually, almost month over month, seen that orange piece of the pie continue to shrink as companies are out adding additional compressor stations, looping pipelines, meaning putting a second or a third pipeline alongside the original, and then more frequent pigging operations, trying to clean and maintain the pipelines, make sure they're flowing at their maximum throughput. And so, again, both of these are going to need to be addressed going forward, and I think that we'll continue to see a lot of significant work on that. Looking at that 3%, the gas gathering industry was outpacing the drilling industry in March, so they were connecting more wells than were being brought online. And so that's always a good sign that if they can get more wells connected than wells that are brought online, they're getting ahead of them, getting ahead of the curve on the drilling side. So with that, I'd be glad to answer any questions.
Well, if I may ask, given the fact that rail transportation is down to about 35%, you said?
Correct. Yep.
Do you ever expect it to get back up to 50% or more?
I don't. It's so the question for those on, do I expect to see crude by rail utilization increase substantially from where it is today?
Production comes back up.
Yeah, and so what's on the horizon is the Dakota Access Pipeline, still targeting the end of this year to go into service. And so that would bring on another 450,000 barrels of capacity. The only way that I would anticipate seeing more rail utilization if there was a major market pricing shift where we saw large spreads between Brent and WTI. We have loading facilities in the state. There are tank cars available. So theoretically, we could see more barrels move to rail if the market drove it that direction. But I don't see that happening anytime soon.
Do we know where Dakota Access is going to start construction, like what areas and which counties?
So the question was, do we know the pipeline construction schedule for the Dakota Access? They are starting construction this month. As far as the various spreads, so they're going to work in spreads. So they're going to have multiple crews working at multiple locations at the same time. I don't have that available as far as where exactly each crew will be starting. The Public Service Commission may have that. They receive weekly construction updates from the company, so that may be one place to check if you want to follow up with that. Okay.
No questions?
Thank you very much.
So that is that. Thanks everybody for coming. Have a good one.
Thank you. Good night.